All right, good afternoon, everyone, and welcome to the final session of the Global Fintech Fest 2022. This is on a panel discussion on how can regulators enable digital financial inclusion. And we have the panel ready with us on stage. The moderator for this session, Ms. Deepti George, Deputy ED and Head of Strategy at Dvara Research. And on the panel, we have Mr. Alok Mittal, Managing Director, Indie Technologies. Joining us virtually is Mr. Nick Cook, Head of Global Strategy and Partnerships, AIR, that's Alliance for Innovative Regulation. Ms. Arundhati Ramanathan, Deputy Editor, The Ken. And Ms. Amira Karim, APAC Public Policy Lead, Payment System Services at Amazon Pay. Over to you. Yeah.
Hello. Okay. Hi, everybody. And we have a great panel here. This is going to be the last, but not going to be the stuff that you didn't miss. So it's really, we are going to be talking about digital financial inclusion. And basically the question is, what does that mean? It could mean multiple things. It could mean you could take a very narrow definition to it, or as broad as you want. But nothing escapes the fact that there is now going to be a digital angle to everything that entails financial services. All the way from lead generation to underwriting to sort of pre-sale, onboarding, post-sale processes, servicing, and so on. And so, what does this mean for? I'll just take off my mic. So what does this mean for the lives of sort of low-income households and even their livelihoods? And by livelihoods, we mean really things like farming, nano and micro entrepreneurs, the gig economy participants, the self-employed, even slightly larger entities like those that fall under the MSME definition. They will have to deal with this shift, right? This digital shift, whether or not it's going to be done well for them. So if we are to take this view that digital financial, inclusion must meet the needs of these target consumers, then this sort of implies that that we need to kind of sort of overcome some of the market level imperatives such as cost and risk considerations, and therefore the context and the environment matters, and that's why the role of the regulator and the policymaker, and that's why this panel. So quickly, I'm going to kind of get into the specifics to the questions. We have with us, of course, the panelists that you see here, but we also have Nick Cook, who is unfortunately not sort of able to join us through through a live session, but we have his sort of recorded videos, and we're able to play. And he was kind enough to give us these recordings, so we're going to play those. So to begin, my question is first to sort of Amira. Before we come to the how of enabling digital financial inclusion, a more basic question to consider. Must regulators and policymakers enable digital financial inclusion, right? And so, and then that goes to sort of Amazon Pay. Do you make a distinction between the financially savvy, the financially comfortable, or the digitally savvy or digitally comfortable versus those who are new to credit, new to digital? Do you treat these as two distinct segments? And is it too much to expect sort of financial institutions, fintechs, and big techs to take on this responsibility for financial inclusion? Or would you agree that there is a need for the government or the policymaker and even the regulator to play an enabling role? Without it, it might be too may not be too lucrative for private actors. So, Amira, over to you.
Thank you so much, Deepti. And as we talk about financial inclusion, I think it's really important for us to think about it not as a monolithic concept, but as a spectrum, right? There is a vast spectrum of underserved needs when we think about, communities that are financially underserved. So on one end of the spectrum, you could have, for instance, communities that live in rural areas that may have struggles to access even basic transaction accounts, to even begin that financial sector journey, right? And then as you shift towards the spectrum, you might also have, other users who may not have access to credit systems for whatever reasons, either because they don't have access to identity systems, they don't have access to collaterals, or they just are not financially literate enough to understand how they could gain access to things like credit to build their businesses or to take education loans and things like that. But as you shift into more urban markets, the financial inclusion definition could also, implicate a lot of people who might have a very sophisticated understanding of existing products, but may not know how to access them for, out of fear or out of, the lack of access to technology. So when we think about financial inclusion, I think it's really important to take a customer-centric approach and to look at all of these customers as bases, as segments where product innovation as well as improvements in processes have to be very, very targeted. So looking at them as very distinct segments that we can address and solve for, individually. But one thing that I've been thinking about as part of Amazon and as part of the broader industry grouping is how do we then ensure that innovation doesn't happen in a vacuum? And a lot of the times, technology companies and companies that are really engaged on financial inclusion need supporting policies, but also supporting partners, whether it is governments who can be, very facilitative and build digital infrastructure, or regulators that set the tone by having very clear regulation. But I think interestingly enough, one underlooked or overlooked partner is really civil society and academics like Dvara research, right? The ones that can help us build behavioral insights, can help us make sense of data. Because data is not just about big data. Data is also about sort of many, many things like cultural and behavioral aspects that have to come together to culminate in making those products and services and innovations actually worthwhile. So as we think about financial inclusion and we serve customer segments, we need to establish an ecosystem approach, and that involves governments, and governments playing an enabling role alongside private companies. And to make sure that we take a very customer-centric approach, we build good governance structures, and we are very collaborative across all of the different segments that I just mentioned.
Thanks, Meera. Turning to Arundhati, we've read all of your work out there, and you've been tracking how sort of DFS has been interacting with the real economy as well as the real digital economy. What are some of the big issues that you're seeing where you think an intervention by the regulator and not laissez-faire may be a better path to take if we were to keep consumer interests in mind? And, but what do we lose in the process? So if you can just talk about two sides of that same coin.
Thank you, Deepti, for the question. I think if you look at the steps that the regulator has taken to keep consumer interests in mind, some very tangible examples come to mind, right? Like be it 2FA, which RBI has almost taken it to the world stage to show that it can prevent frauds, it acts in the consumer's interest. Similarly, when it comes to, say, laying down collection guidelines for the recovery agents, thinking of the last mile and laying down guidelines there, that has been in the interest of the consumer. And even something new like a P2P lending guidelines that they laid down even before the industry kind of took off, saying that if you want to invest more than 50 lakhs across platforms, show your net worth to the platforms, right? Which again shows that it cares about potential lenders, investors not losing their shirt by lending irresponsibly in the, thinking of returns. So I think those are great examples. But when we think of customer interest, I think access also needs to be a part of the conversation, and how whether fintechs are enabling access is something that should be an active part of the conversation. Because today it's all about, fintechs are bringing in growth and valuations. That seems to be the narrative. But how can we bring them into, bring them to be a part of the financial inclusion narrative is, I think, something that is missing. And I think there, say take payments, for example. It's still a very 150 million user phenomenon. We know credit is an untapped market, right? So, can the regulator, like we have priority sector lending guidelines, can we maybe think of a priority payments, right? Can we establish payments as a priority for fintechs and get them to be a part of that conversation? I think that piece will go a long way in regulatory interventions for in customers' interests.
Must policymakers take the responsibility for enabling digital financial inclusion, right? So in this context, we should maybe speak about sort of public goods and subsidies. And the latest is today in terms of UPI, right? It certainly has a public good character to it. But then it becomes murky when we are thinking of can providers charge for offering services that add value add to the UPI base case itself. And then when we look at sort of the other existing more well-established subsidies, like for example, interest rate subventions for small farmer agri loans or for MSMEs. So what must the rules of the game be when we have to consider sort of government support as an option?
Yeah, I think the first question here really is, should the government be doing this, right? And I think financial services does have significant externalities, which are not captured in the transaction. If you remember, the initial purpose of Aadhaar was to make sure that benefits can be delivered more efficiently, right? So it wasn't just a lever to say we'll drive financial inclusion or give every Indian an entity. It was driven by a very, core business purpose of avoiding 30 to 40% leakage in transmission of benefits, right? Similarly, getting more digital payments out there is driven by the desire to be able to track payment flows, enhance tax revenues, reduce money laundering. So I do think that there are very good reasons and tangible reasons why the government should be playing an enabler in the financial services area. I think the converse question to that is where should the government stop, right? And in my mind, a lot of that is where do you want to start tapping into the power of innovation and competition, right? So sure enough, UPI as a platform is now established, right? Is this time ripe to bring in competition and innovation on what kind of services get offered on top of UPI? Credit on UPI being one of the things that is, being talked about. And I think at the stage where you start realizing that now the infrastructure is in a reasonably good shape, and you want to start services being developed, competed for, customer to have choices on how they consume these services, that is really where, in my mind, the government role stops. Right? The second key element is, where is the market failure, right? So to your point, I think in the agri loan space, right, the reason why those subsidies have existed for the long time, apart from whatever the political rationale of that might be, is because there is genuine failure of the private sector to go out and deliver in that area, and it is considered to be a segment of the economy that needs to be supported. Just if for nothing else, sheer number of people who are engaged in that activity. So I do think that there is a good framework which is not just to be developed but has been adhered to, even in the past, in terms of where is it that the government should participate, and then where is that rough boundary beyond which entrepreneurs, innovators, private companies should be allowed to function.
We have a question for Alok. Nick who has shared this video. So let me just read out the question because I think that's important. We asked this question to him, right? Must digital financial inclusion be enabled? And the question here is, what is the prerogative here? In whose interest is this, right? How must one consider the organic way to adoption of digital financial services versus the inorganic? And so what I would ask is
Thank
to play
you. Hello, everyone.
Nick's response.
Firstly, I'd just like to express my regret and apologies for not being able to join you in person for this event, and my disappointment that I have had to record some comments rather than provide these live during the session. I hope you have a great conference, and thank you for including me and inviting me. So when we think about financial inclusion, it can be seen to benefit both individuals and economies, societies at large. Access to financial services can open doors for families, allowing them to smooth out consumption and invest in their futures through education, health, and the purchase of productive income-generating assets. Inclusion can also increase security of money over physical storage of cash, for example, giving individuals and families more safety and security around their wealth. Furthermore, access to credit can enable businesses to expand, creating jobs and reducing inequality in society. And I think it was the World Bank that said financial inclusion is the bridge between economic opportunity and outcome. Experience offers us a number of key lessons around enabling financial inclusion. I know the panel will discuss this more, but just to share a few thoughts, we see that financial inclusion must be closely intertwined with the process of financial sector development. If inclusion means access to banking, for example, then those services need to be closer to where the people are, offering deposit taking, payments processing, microfinancing, mortgages, insurance, at the places and through the channels that consumers are comfortable with and have access to. Central banks obviously also have a very important role in creating the enabling environment for financial access. It's their role to get the right balance between ensuring access to financial instruments and ensuring that banks are sufficiently protected from instability and risk. And then on top of that, governments have a very key responsibility to provide the laws and the regulations that encourage financial sector development and inclusion. Regulations around things like the account opening documentation requirements need to be carefully contemplated. Customers might be excluded if they're required to provide, for instance, a fixed address or proof of employment. And so certainly there is a need for government and industry to work together to ensure that the infrastructure backbone is available within a society. One further example, things like the ubiquitous presence of interoperable point of sale devices and the widespread acceptance by merchants of mobile or digital payments. So there may be additional burdens for some consumers, particularly where the regulations have not been developed to take account of the documentation that citizens have available, or where the ability to transact is limited by a lack of merchant acceptance or limited interoperable point of sale infrastructure, or where access to financial services is not proximate and close enough to the citizens seeking or required in some cases to use those services. So there's various things to get right, but if these pieces are put in place, then financial inclusion can be seen to benefit both individuals and societies.
Just moving on, I'd love to hear from Amira, right? So we know that now Singapore is implementing the UPI corridor, and there are many other countries where UPI-based solutions are being considered or implemented, like in Brazil. And then the Monetary Authority of Singapore has been a front runner in really proactively engaging with fintech innovation. So how would you characterize the Indian story with both UPI and the broader fintech ecosystem against what you're seeing in at Amazon Pay or at Stripe or in any of the other jurisdictions that you're tracking, even beyond Asia?
Absolutely, and that's a great question, Deepti. I think that the UPI story is extraordinary for two main reasons. One is that it is testament to the power of public-private collaboration and also in building infrastructure. And then the second reason why UPI is extraordinary is because it provides a really important use case for making access and affordability front and center for financially excluded people. So let me go to the first point, right? The first point relates to how, with the UPI success is really founded on the India stack and how the India stack was developed with inclusion in mind. The first layer being Aadhaar, kind of giving access to identity systems for people who didn't have access to identity systems, opening up not only financial inclusion, but other citizenship services. And I think that had also immense value in ensuring that their voices were heard in the policy-making process overall, which I think Nick referenced as being really critical, the overall economic policy-making process. The second layer in terms of building UPI's common standards so that non-bank financial institutions, traditional financial institutions, and whatever other player that wants to compete can compete on a level playing field. So I think that kind of interoperability, the fact that it was built on common standards allowed, different kinds of companies to compete and innovate on a level, on level grounds. And this created a lot of opportunities for innovation. And so we see the UPI as a starting point to lots and lots of other things that had tremendous value for financial inclusion. The third aspect, which I think is really exciting and is really moving India away from just an open banking-esque kind of economy to one that is open data, related. And I think that has tremendous value because if you look at how now the data systems and data fiduciary management is becoming a thing where customers can give consent so that companies, like Alok's company, and lots of others can provide, different kinds of services, whether it is payments or credit and what have you. Those layers are really, really critical. And what's really interesting is that none of these layers are unique, but India managed to orchestrate all of that in a comprehensive way that allowed them to then kind of bring financial inclusion more meaningfully. I think to take a step back, I wanted to also kind of highlight the fact that the reason why developed and developing economies are so interested in studying the India Stack and UPI is because of the potential to bring costs down. As you know, payments is not cheap. Making a payment, whether it's digital or whether it is analog, is really an expensive endeavor. And UPI and a lot of instant payment systems like PayNow in Singapore attempts to bring that cost down to zero or as close to zero as possible. Now imagine the power of being able to build services on top of a payment system that is low cost, and how much that can help, bring so many underserved communities to the fold, right? And I'm not just talking about consumers, I'm also talking about companies that want to make payments not only domestically but across borders are now going to be able to do that with all of these corridors. And I think there's tremendous value in that. I just wanted to highlight that I'm very excited that India is going to be the chair of the G20 next year, and I think can really take that work forward. The G20 has a roadmap that looks at bringing cross-border payments to become more efficient, to be more affordable, and to be more accessible, especially to underserved MSMEs that, we have plenty here in India and many parts of the world. And I would really like to see, the G20 kind of lead on this effort. And MAS also has announced that it will start building essentially a technology platform that brings together instant payment systems in a way that makes them interoperable and allows them to connect seamlessly. So kind of building a tech stack, if you will, that allows UPI, PayNow, and anyone else who wants to participate. The power of that for consumers as well as micro entrepreneurs is immense. And so I'm really excited for the UPI kind of model to be studied, especially with India in leadership of G20 next year.
Great. So again, I think it's going ahead. Question to Nick that we had posed was that we all know to different extents that innovation precedes any intervention by the regulator. And at least in developing economies, we see the regulator, play a wait and watch game, and then when it feels that things are getting slightly out of hand, that's when they intervene. But is there really an alternative path to consider, right? Is it, it's not just that we need a proactive regulator on many fronts, because we have seen proactive regulators in India. But what about deciding rules of the game in an ex-ante manner, and really, setting the, the sort of the contours of the market within which. So basically, this is the grand turf within which private actors can act and innovation can happen, right? So how do we kind of so the question to him was what are the kind of pitfalls to keep in mind? And there's no silver bullet, right? Like there are all these different models of regulation, but what are the kinds of worries that concerns that one need to keep in mind, right? Because if you lock down too much or too many of the moving parts, we may end up really killing market solutions before they are even born. So so this was his response.
I think, in my opinion, the worst approach is the do-nothing approach. Wait and see, if taken literally, is never likely to be sufficient, in my opinion. Waiting until something is significant and impactful before paying it due attention is not a shrewd or responsible approach to regulation. So I'm careful to use the words wait and see. I much prefer the more active but still neutral stance of kind of observe and evaluate. I think that's the bare minimum stance and approach that a regulator can take in an innovating and evolving market. The downside of this more neutral, observant approach is that the response, when it comes in the form of legislation and regulation, may not be fully informed, or it might take quite some time to implement. And if a decision to act is triggered only after an innovation has grown to a very significant scale, one must consider what further risks or harms may evolve and grow during the period of action and response. Determining the time to act can also be difficult. And my former boss, Chris Woolard, once said, the move fast and break things approach that is famously advocated by some technology leaders is just not appropriate when we're dealing with people's money, livelihoods, and security. However, setting rules or specific requirements too early in an innovation's lifecycle can stifle desirable future states from emerging, and can reinforce status quo situations, which, if we acknowledge and recognise that both in the emerging and mature financial markets there remain customers who are unserved, underserved or mistreated, one should be rightly cautious about maintaining a current state which is itself suboptimal. So you see some regulatory regimes rely more on principle-based approaches, where they set out core higher level standards by which regulated institutions must conduct their business. In some markets, it's said that these principles seek to specify the intention of regulation, so that the market actors are clear what is acceptable and what is not. And these principles-based regimes are often cited as being slightly more future-proof or flexible, but they can create uncertainties and vagaries which may be unhelpful to innovators. Innovators both thrive in uncertainty, but are also stymied by it. It can be hard to raise investment funds in an uncertain environment. So others are now touting a third approach, one of outcomes-based regulation. This is seen as a potential model to address the lack of clarity in principles-based regimes. And outcomes-based regulations seek to provide a clearer description of expectation or best practice that can provide sufficient direction for business policy, processes, and decisions. So the hope is that such regulations will ensure more consistent market practices and treatment of consumers than is enabled by a purely principles-based regime. So I think there are various options as to how one could go about doing this, and there are definitely downsides of intervening too specifically and too restrictively too early. But a pure wait-and-see approach, in my opinion, is flawed, and the very minimum should be one of observe and evaluate.
So observe and evaluate. So over to you, Alok. What is your reading of what's happening in the regulatory space in India for financial services, right? Both offline and online. You've seen both worlds, pre and post this whole digital wave of disruptions that we are seeing. So do you think directionally the Indian regulators have been able to enable digital financial inclusion, avoid sort of costly mistakes, incorporate learnings from other jurisdictions, both sort of, even before the digital world. So we are seeing business models undergoing swift changes because of, for example, the latest, some of the new announcements by the RBI in terms of digital lending. And this kind of reminds me of a decade back when, for example, Malegaon Committee was set up to start regulating microfinance. And some of those rules have very recently, a decade later, recently been sort of updated or upgraded last year. And this also reminds me of the events. For example, SEBI had abolished volume-based incentives for mutual fund distribution. So where are we in this continuum? What's your reading of what's happening now?
So I think on a comparative basis, the regulators in India have done a great job of controlling systemic issues, right? Whether we go back to the global financial crisis and how India fared through that. Arundhati made a reference to the peer-to-peer guidelines. Both in the United States and in China, those businesses went through a lot of consumer disruption before regulations could really rectify that, right? So while one could argue that in India regulations came in a bit ahead of schedule, but we have prevented customer harm through those regulations. I think there are 2 or 3 challenges that exist in the regulatory space at this point in time. One is that the regulatory architecture, and Nick referred to some of those issues, isn't quite out there, right? So today, RBI is having to regulate customer data. The PDP, isn't seeing the light of the day. And so that burden of consumer protection, consumer data protection, which ideally should be at a different layer in the regulatory architecture, is falling on a financial services regulator. And I think that there's a conflict and confusion that draws, right? Second is, just the ability to exercise supervision in an ecosystem that is spreading fast. So from just the banks to the banks and the NBFCs, and now literally financial services being packaged into any business just calls for a very different supervisory capability. And I think the recent digital lending guidelines, the regulator has tried to balance that by trying to enforce regulation through the regulated entities rather than directly try and regulate literally every company out there. So I think there are some of those challenges, but on the balance, I do think that the Indian regulators have specified the intent of regulations. They are quick to act when that intent is violated, and at the same time they've managed to control the systemic harm that has been observed in many other geographies.
Okay. Moving on to Amira, right? So what has been the journey for Amazon Pay and more generally for sort of the payments ecosystem when it comes to engaging with multiple regulators and enforcement agencies? Because that's the next, like post-regulation, we are thinking of supervision enforcement. Do you feel that there is considerable duplication of efforts internally, or so perhaps greater interregulatory coordination is required, even supervisory technologies that can reduce the burden on providers? And we're not just talking of compliance, although compliance burden is, of course, or rather compliance interactions are one part of the set of interactions that providers have with regulators. But what about like law enforcement officials, cybercrime investigation agencies, other regulators other than the primary regulator? So what's the experience been?
Yeah, that's a great question. I think when we think about technology, I think we need to realize that technology will never be a good substitute or replacement for good policy making, right? And that technology can be leveraged to assist when there's already an underlying system or there's already a lot of clarity as to what the goals of the compliance mechanisms are or what the goals of the regulatory regime are. So technology can be applied ex post when we already have regulatory clarity. I think from my experience observing the fintech industry, both as part of the private sector, but also having been in government before and having been in the World Bank before, regulation is hard, especially for new technologies. And in the payment space, throughout financial services, there's a new technology kind of introduced every single day. Whether it is blockchain technology, whether it is looking at, hybrid systems that bring together correspondent banking with fintech. There's so many new developments that as a regulator, you have to grapple with all of these new developments, but also maintain your eyes on, the bigger prize, right? Like fiscal stability and things like that. So it is a very complex undertaking. And then overlaying that with goals like financial inclusion, it makes it immensely difficult. So I'm not so concerned about duplication when I think about helping companies navigate the complexities of a system. I think about clarity, and I think about clarity from both sides. Having been on both sides, right? How can we help, as industry, how can we help our regulators gain better insight into ways to regulate us more smartly? How can we collaborate with our regulators so that they understand what we're trying to do? And what customers we're trying to also affect. And a lot of that has to do with trust building and also transparency. Building mechanisms, as part of the private sector to inspire transparency and transparent ways of communicating that also then allow regulators to really understand what frameworks to apply on us, whether we are a payments player, whether it is our lending product, or whether it is essentially the e-commerce store that they have in mind. So I think kind of looking at ways to build better transparency and earning trust through transparency so that there can be smarter regulation. I think the other aspect really is, as we think about national financial inclusion strategies and we see, so many different players come to bear, I think it'll be really important for us in the next phase of financial inclusion to start developing very strong concrete metrics. And what you can't measure, you can't really impact and you can't really bring about. So I think what's kind of missing right now in the overall national financial inclusion strategy are goals and targets that allow accountability to be established. And I think this is one area where we can really work more closely, with a regulator as part of industry and as part of civil society as well. Because again, we also need to understand, how the context and the landscape of the people we're trying to affect, is evolving along the way. So I feel like if we bring all of those factors together, clarity as well as having targets and clear goals, I think that will really boost, the ability to innovate, but also help regulators, navigate all of the new systems and maybe reduce duplication, right? Especially as we think about emerging economies or major economies like India, where there are lots of resource constraints. So we need to build that kind of by design, something that can be measurable and inclusive.
So quick sub-question to you, Amira, is do you see, because you've looked at different jurisdictions, do you see certain sort of jurisdictions or the jurisdictional regulators being more open towards providers, especially also from kind of like law enforcement agencies versus others? Like, do you see a good diversity in how practice providers are sort of perceived?
I think there are, achievements and drawbacks in all jurisdictions. So I think in India, to Alok's point, RBI has done a great job coordinating all of the responses to new technologies and grappling with a lot of complex issues. So I think that, they've been really staying on top or in step with the rest of industry. I think that there are some smaller economies that have been able to develop prototype regulations, like Singapore, for instance, a less complex jurisdiction, but one that is very technology forward, that allows for experimentation to take place, and then maybe develop, use case based regulation, right? Kind of not jumping in before, but also observing, as Nick mentioned, and developing regulation based on those use cases. So I think Singapore does a good job of that. And then if we think about how, in the UK, there is a reason why, the UK is also the hub for fintechs, because they also have a strong enabling environment that ensures that fintech voices are included in the regulatory making process. So ensuring that, fintech companies are also have representation within that kind of policy making process is really critical. It may not seem like a lot, but it also helps the regulators to stay in step and ensure that that they are building policies and regulation for that particular diverse interest.
Okay, thanks. So speaking of UK, again, we had a question for Nick that kind of deep dived in the question of what's happened there. And there we know that the FCA really reflects what's called the Twin Peaks model, right? Like basically splitting prudential and sort of conduct regulations between two different regulators, so that both of them are taken equally seriously. And in India, we know that for unregulated entities, lending activities, for example, the RBI and the Indian government are considering a new law to ban unregulated lending activities. And that engages in public lending, right? Anybody who's not registered with the RBI or any other law and undertaking public lending the plan is to kind of ban them. And public lending is not defined today, but we know that a lot of unregistered sort of money lenders have been lending for centuries. And then we have sort of non-financial corporates who have been lending. They just don't meet the 50-50 criterion of the RBI, and hence do not require any license from the RBI to undertake lending. So we asked Nick how he could, to give us a sense of how the UK FCA has tried to obtain maximum coverage of all forms of lending while keeping fairness of all actors in mind. So just, retail credit's biggest worry is really sort of over-indebtedness or over-borrowing. And this can become a systemic concern. And so the worry is really valid. So just to kind of deep dive into what's happening in the UK.
In the UK, generally retail credit is regulated, and businesses which offer credit or financing to customers must be authorised by the FCA. The UK has progressively brought more and more of the consumer credit market under regulation. As the market has evolved with new and different product offerings, the uptake by consumers has changed over time, and new harms and risks have come to light. And the FCA has sought to upgrade requirements and specific rules around particular products and market practices. Generally, it intervenes where it identifies problems and issues. There's been various spaces and ways in which the FCA has intervened since it took over responsibility for consumer credit in the UK in 2014. In 2015, the focus was on things like payday loans and other high-cost short-term credit products. The FCA introduced a cap on the interest rates on such loans. This is one of the most kind of strident and specific rule settings in recent years. And it followed on from earlier measures that the FCA had put in place around risk warnings that needed to be made clear to consumers, restrictions on rollovers, and restrictions on how things like recurring payments could be collected. What I would just note is the FCA's intervention on payday loans was based both on kind of traditional supervisory and risk evaluation processes, but also involved a lot of work in the use of behavioural economics, including things like randomised controlled trials to test how different consumer messages and warnings would or would not be effective. The FCA reviewed the impact of its rules a couple of years later and found that over 750,000 borrowers saved around £150 million per year with cheaper loans, better affordability assessments, and fewer customers experiencing debt problems. What I should flag though as well is that the FCA's intervention also led to a significant shrinking of the payday loan market, with a number of businesses basically leaving the market. The FCA introduced further rules in the credit markets, also again in 2014. It undertook what it calls a thematic review of the debt management sector, found that the quality of advice provided by fee charging providers was too low. This led to a series of past business reviews and requirements for specific firms to pay redress to consumers who've been mistreated. The FCA has also intervened with price comparison websites and had concerns around the way in which relationships between the websites and various lenders influenced where and how certain products were promoted to consumers. So in 2016, it placed requirements on these price comparison sites around how they transparently showed products and services that were available. The FCA has also used market studies. These are really in-depth data analytics and competition assessments. Probably one of the most famous ones is work around credit cards. It looked at over 34 million customers' accounts across a 5-year period, and found generally that competition was working well, but did identify significant concerns around problem credit card debt holders. This was a group of about 3 million customers who'd been seen to pay more in the previous 18 months on interest, fees and charges than they had repaid of their borrowing. And new rules were implemented to encourage firms and customers to avoid persistent debt, and to ensure that customers who couldn't afford to repay were given help and forbearance more quickly. Again, the FCA estimated that these changes would save customers up to £1.3 billion per year. Further changes have been made by the FCA around different aspects of the credit market, looking at things like motor finance, guarantor loans and other products, and other policy remedies and interventions have been introduced. And just to pick up your point around affordability, recently the FCA's focus has been on the rapidly growing buy now, pay later sector, which is unregulated in the UK. And a thorough review of this market looked at how products were promoted to consumers, how those affordability assessments were undertaken or not, and how risks were being explained to consumers. Very significant harms and issues were identified. And so the FCA and the UK government is now in the process of bringing such products within the scope of regulation in the United Kingdom. In the meantime, and I mentioned this in my first comments earlier, there's a need to also protect consumers. So the FCA has been very, very active with its risk warnings for consumers about buy now, pay later products. Thanks.
Okay, we're nearing the end of this panel. So question to you, Arundhati. What might be some of the important trends and issues that you're picking up, and you're looking out for at the KEN, given digital financial services and regulatory interventions? These are really sort of hot topics today. Sort of have our discussions today really added anything new to your list?
Of course, Deepti. I think given the spate of regulations that we have seen in the last year and a half, right? We've seen that there is no perfect regulation that way that can come. You're either under-regulating or you're over-regulating. So I think that's something that we will be watching for, and the impact of that. I recall this example from a reader when the recent guidelines on credit line-backed PPI cards were banned by the RBI. This reader wrote to us saying that, this was a product that was actually seeing traction. People actually found use for it, right? So there was it found that product market fit, though it did not really comply with what the regulator had thought of initially. It didn't comply with it. That part is, there is no denying that, but it did have its use in the market, right? So I think when we look at regulations that come into the system, I think the way we judge it has to be through all the prisms, right? So I don't know, maybe with the help of all of you, I can develop some kind of a scorecard, as to how much of a benefit this has on the user, how much on the system participants, on the banking partners, on the ecosystem. So I think we need to see it from that prism and then see who does this benefit or not benefit so much. The risk with so many regulations coming back to back is, if we are over-regulating, then are we financially actually excluding people? Like the PPI card example that I gave, if there was actually potential for that to reach the bottom of the pyramid who needed that credit, are we now suddenly excluding them? So I think those are conversations that we need to bring about actively. And definitely, I mean, even as a reporter, I've not really looked at when I'm writing about fintechs. It's about the valuation, about the unit economics. We're not talking financial inclusion as much. So I think as we report, this discussion makes me think of so many aspects that I think we can weave into our narratives as well, as to how and judge companies based on that.
Fantastic. Any parting thoughts, Alok? This has been a 3-day fintech fest here, but looking forward, what are your thoughts?
No, absolutely. I think this festival obviously provides an opportunity for players from the industry. And I saw regulators walking the corridors, and that's brilliant to see. So I think it's a melting pot of all viewpoints in this industry. I think at some level, the regulatory task and the policy-making task is also split between what is perceived to be detrimental to systemic stability. And I'm not even talking about capital concerns and things like those. Innovation that may disrupt existing players can be detrimental to systemic stability, just by virtue of the players that it tends to disrupt.
That's a whole new panel topic.
And on the counter side, those kind of innovations are potentially the innovations that are going to solve for inclusion and digitization. So I think that's an interesting tightrope to walk. I am very encouraged by the fact that this discussion is happening not purely in a spirit of competition, but collaboration. So a lot of the fintech industry developments, at least in India, are led by fintech bank partnerships. Whether it is in payments, it's in credit, insurance, whichever product you look at. And I think that architecture allows a more conducive dialogue to happen on where are really the risks of disruption and where is the inclusion opportunity. So that is what excites me about this ecosystem.
And you think the partnerships are here to stay?
I think the partnerships are here to stay. As much as fintechs want to grow fast and scale fast, the reality is that there is a product market fit of fintechs with the financial services industry, right? They are solving a problem. They are spreading the ambit of inclusion. We've seen research now done by bureaus and so on, which indicates that a large part of new to credit is getting powered by fintechs, right? So at an industry level, there is a product market fit, and there's no reason why it won't scale with the right regulatory guidance.
Great, thanks. Amira, you have the last word. What are your big thoughts right now?
That's a big responsibility to have the last word. Thank you, Deepti. I think that it's really encouraging that I've been listening to a lot of panels at this GFF, and financial inclusion has come out as a theme in most of them. So it sounds like a lot of people are thinking about financial inclusion and keeping financial inclusion as one of the North Stars, whether it is talking about product constructs, whether it's thinking about regulation, or whether it's thinking about, how can we improve business processes. So it's really encouraging, from my perspective, to hear this be a theme that cuts across so many different discussions today. I wonder if, to Alok's point about collaboration, and I think competitive collaboration is also good, right? We want to make sure that we're not just collaborating to be nice, but to ensure that we are serving the people that we say that we're serving. And I think that's really important to keep in mind, especially as we enter, 2023, which is meant to be a year of uncertainty in many respects, with a lot of economies kind of slowing down. I think there are lots of mutual areas of alignment, bringing costs, down as much as possible so that financially excluded, communities can still benefit from digitization. I think that's going to be, an important kind of guiding principle underpinning what we do at Amazon. I think the other thing that I've been thinking about and, always love coming to India for this because there's so much, energy surrounding fintech innovation. How can we ensure that the fintech community is able to ride the wave and become more resilient and then have spillover effects that are not just centered on India, but also over the rest of the world? Kind of ensuring that fintechs in India can go global so that the lessons that they have, learned, that the products that they have built in this market can be externalizable in other places that have very similar kind of constructs and needs. So I'm very excited about that, and I'm hoping that 2023 brings that for us.
Great. Okay. All right. So with that, we're going to wrap this panel. Thank you so much to the Global FinTech Fest and their organizers. Thank you so much.
Check. All right. Thank you very much. May I request our panelists to please pose for a group photo? And with that, everyone, we come to the end of the Global FinTech Fest here in this hall. There's one session still going on in Jasmine 1. If you'd like to attend that, we invite you to attend that. We'd like to thank our partners for the Global FinTech Fest 2022, our theme partner, WhatsApp, co-powered by Amazon Pay, spend management partner, Encash, in association with Perfios, payments partner, Cash Free Payments, CEO's dinner partner, HSBC, our platinum partners, Google Pay, PhonePe, Visa, M2P Fintech, MasterCard and Falcon. Our registration partner, Entity Data Payment Services. Our communication partner, Kalera, banking partner, Standard Chartered Bank, diamond partners, PayU, AWS, Kia.ai and Paytm. Our networking partner, Buddy Loans, our country partner UKFCO, Kingdom of Netherlands, our credit score partner Paisa Bazaar, conversational commerce partner Carix, P2P lending partner Faircent, VIP lounge partner Cred, and InsurTech partner Cover Genius. Thank you very much to each one of you for having been a part of the Global FinTech Fest. For updates about Global FinTech Fest 2023, do check our website. We will be updating that regularly. Thank you very much. I'm your host, Chaitanya Rathi, signing off. Have a safe drive home.